The Senate can't agree on an ethics clause, and institutions stopped waiting for them to figure it out. That's the conviction capital story nobody's covering because it doesn't fit the narrative that everything's stuck until Congress acts. Here's what actually happened while the Clarity Act sat stalled. Let's slow down because the timeline here matters more than the headline. Think of the Clarity Act's current holdup as simply a disagreement over one specific rule, a provision meant to stop government officials from personally profiting off digital assets while they're the ones regulating them. That single ethics provision is what's kept the bill from clearing its first Senate procedural vote, now pushed to September 15th. Most retail coverage treats that delay as proof the whole institutional story is on hold. It isn't. In plain terms, one contested sentence in a bill is holding up a vote, but it isn't holding up the money. Here's what that actually means for you as someone tracking where real capital is actually moving. While that vote sat delayed, Ripple Prime, the company's institutional brokerage arm, closed an upsized capital raise worth $275 million. Think of a senior notes offering as simply a loan a company takes from investors, promising to pay it back with interest, used specifically to fund expansion rather than day-to-day operations. Investors don't commit $275 million to expand institutional brokerage infrastructure because they're waiting to see what Congress does. They commit that kind of capital because they've already made their determination. Strip away the institutional language, and here is what is actually happening. Professional investors just placed a $250 million bet on institutional demand for digital asset services accelerating, regardless of the Senate's calendar. In plain terms, the people with the most to lose from being wrong just put real money behind XRP's institutional infrastructure while Congress argued about wording. Now let's go into why capital moves on a different timeline than legislation, because this is the part most coverage gets backwards. A relationship scorecard is simply the internal rating a counterparty builds on a partner over time, tracking reliability, compliance history, and operational performance before committing larger positions. Institutions don't build relationship scorecards based on statute. They build them based on operational track record, and that track record has been accumulating regardless of where the Clarity Act sits. Here's what most people miss. The SEC and CFTC's Joint Interpretive Guidance from March already gave compliance departments a documented classification framework to work from. That's the floor institutions needed to move. Statute was always the slower secondary confirmation, not the trigger. Most people hear waiting on Congress and assume that means waiting on permission. It doesn't. It means waiting on formalization of something that's already operational. Put simply, institutions aren't defying Congress by moving now. They're moving because the actual gate that mattered already opened months ago. Let's talk about what's showing up in the on-chain and capital markets data, because the numbers back this up. Whale wallets added roughly 380 million XRP off exchanges in a single week this August. Exchange reserves hit a 7-year low, and now a $250 million brokerage raise landed on top of that. Here is the part they aren't telling you. That's not 3 unrelated headlines. That's the same underlying conviction showing up in 3 separate places: on-chain accumulation, brokerage capital formation, and institutional infrastructure expansion, all moving in the same direction at the same time. That's not a guess. That's how the ledger and the capital markets data are both coded to tell the same story. Here's what that actually means for you. When multiple independent data streams point the same direction without coordinating with each other, that's a stronger signal than any single headline, including a Senate vote. There's a structural reason capital moves ahead of legislation every single time, and it's worth understanding instead of just observing it. Think of regulatory statute as the finish line in a race, and operational infrastructure as the actual course runners have to complete to get there. Institutions that wait for the finish line to be painted before starting the race lose to institutions that started running the moment the course became passable. The March SEC and CFTC guidance made the course passable. It gave compliance departments a documented classification, gave custody providers a defined risk perimeter, and gave brokerages like Ripple Prime the operational clarity needed to raise capital and expand. Here's what most retail coverage misses entirely. Capital formation events like a $275 million senior notes raise don't happen on a whim. They go through months of internal due diligence, legal review, and investor commitment before the announcement ever becomes public. That means the conviction behind this raise was forming well before the headline, likely running in parallel with the same months Congress spent negotiating ethics language. Put simply, by the time you see a capital raise announced, the institutional decision making that produced it is already old news internally. The public just found out. In plain terms, capital doesn't wait for legislation to move because building the infrastructure and raising the money to build it takes just as long as passing a bill, and smart institutions run both clocks at the same time instead of one after the other. Let's talk about what this pattern has looked like historically, because it isn't unique to this moment. Every major institutional build out in finance has followed the same sequence: infrastructure first, formal statute second, because regulators move slower than the market participants asking them for clarity in the first place. Basel III itself took years of bank level implementation before every provision was fully codified, and banks didn't freeze operations waiting for the paperwork to finish. Here's what that actually means for you. This isn't XRP getting special treatment or unusual momentum. It's the completely normal pattern institutional finance follows every time, playing out in a sector retail assumed would work differently. Now, here's the honest caveat: because this channel doesn't sell certainty, it can't back up. None of this guarantees the Clarity Act passes in 2026. Polymarket traders currently price the odds around 14 to 21%, down sharply from where they sat earlier this year. Here's what that actually means for you. If the bill fails to clear its September 15th procedural vote, the legislative story likely goes quiet until next year. But quiet legislation doesn't mean quiet capital. In plain terms, the bill might stall again, and that wouldn't be a surprise. What would be a surprise is capital formation stalling alongside it. And right now, there's no evidence that's happening. So here's your systemic defense blueprint, the part you can actually use. Stop treating the Clarity Act's Senate calendar as your primary signal for institutional conviction. Track capital raises, brokerage expansions, and OTC accumulation data instead. Those are the numbers that move independently of legislative gridlock. Watch September 15th for what it actually is: one procedural hurdle for one bill, not a referendum on whether institutions believe in this asset class. And when you see a headline framing stalled legislation as stalled adoption, check whether capital formation data backs that framing up. Right now, it doesn't. That's conviction capital, not a prediction about Congress. A documented pattern of institutions moving ahead of the vote they're supposedly waiting on.